up by 0.5% in the end. And as you can see from the intraday graph behind me, a lot of the excitement was in the last hour of trade, where we did see the market rising from a flat result to rising 0.5%. That's in line with what we saw in terms of the Aussie dollar as well. And if we have a look at the Aussie dollar, you can see that just in the last hour, we've seen quite a big spike upwards. One of the things we've been watching very carefully today is the China 7-day repo rate. And we did see a fall today, down from 8.2%, which we saw on Friday, down to 5.6%. And that seemed to have a positive impact on markets around the region. We're also seeing the US futures up 0.4%, so that had a positive impact as well. But if we have a look around the market, the industrial sector coming under a fair bit of pressure today. We did see Toll as well as Sydney airports down around about 2%, but both of these stocks trading ex-dividend, and there were a large number of stocks trading without their dividends on the market today. We saw the utilities and the property sector coming under pressure, but on the flip side, the banks really holding up the market. The banks and the healthcare, the star performers on our market today. So a slow day, but a good day for our market, up by 0.5%.
This year, it's always good to get an understanding of what to expect next year by getting across what's happened this year.
Well, it's been a good year. The market's up by 13%, and if you include the dividends, we're up by 18%. And while it's been difficult to find value, I guess there's two ways to find value. One is on a price level. When prices pull back, things look cheaper. But the other is when earnings increase. And as earnings increase, things look cheaper as well. And the great news about 2014 is we're really in an inflection year, where in the last 3 years, we haven't seen much earnings growth, or we've seen negative earnings growth. And in the current financial year, we're predicted to see earnings growth. And the market moves in cycle, earnings move in cycles, as well as interest rates moving in cycles. And if we have a look at the earnings cycle, we're very much at an inflection point where we're coming to the growth end of the cycle. So I think in 2014, there'll be 3 themes to chase. One is cyclical stocks. As we do see the cycle turning, we should see an uplift in those cyclical stocks. And we've already seen it this year on the market with Kathmandu, as well as JB Hi-Fi, some of the best performers on the market, up more than 100%. I think the second theme will be the continued weakness in the Australian dollar and the strength in the US currency, and that will be great news for stocks like Amcor, Brambles, QBE Insurance, Crown, CSL, ResMed, just to name a few stocks. And the third, David mentioned, is the housing improvement that we'll probably continue to see, and that will not only benefit some of the building material companies like Brickworks, CSR, but also some of the property developers like Stockland and Mirvac, or even some of the retailers like JB Hi-Fi.
Do you think, Julia, the RBA would have been a little bit disappointed by the shallow fall in the Aussie dollar we saw off the back of the tapering announcement?
Absolutely. I mean, the RBA has been quite frank that it does wish to see a lower Aussie dollar, and if we do see a lower Aussie dollar, that would be happy to keep interest rates on hold in 2014. And I think that's the expectation of the market, that 2014 we will see the Aussie dollar on hold. We'll see the benefits of that lower interest rate continue to flow into the economy, and that should be good news for stocks. And in 2015 we'll probably see interest rate rises. And if we have a look at interest rates and the relationship between rates as well as the share market, generally you think that lower interest rates tend to be good news for companies because it makes it cheaper to grow. But in actual fact, the correlation between interest rates and stock market rises is quite high. So as interest rates rise, usually you see a corresponding stock market rise as well. And as interest rates are falling, usually you see the stock market falling. And that's been the historical relationship, which I guess makes sense because interest rates do tend to rise when the economy is strong.